how to trade bankers levels 0, 0, 2, 5, and more for low risk, high probability entries. Before we get started, I want to direct your attention to the risk disclaimer on your screen to make sure you understand all the risks associated with foreign exchange trading. In the following presentation, we will learn how to enter high probability, low risk trades at key levels of institutional support and resistance. Support and resistance levels are the foundation of trading the financial markets. Being able to quickly identify significant areas of support and resistance help traders enter the market with the least amount of risk, with the most amount of potential gain. There are many types of support and resistance available to traders, like Fibonacci, floor pivot levels, classic support and resistance, and even Bollinger Bands and moving averages. No matter what method is used, the goal is to determine the turning point or points of continuation in the market. The $5.1 trillion a day Forex market is dominated by a handful of very large and powerful banks. 50% of all Forex volume is traded among the interbank market. The biggest and brightest minds in the industry move orders with a minimum value of $5 million and can be as large as $1 billion in a single trade. But how are these big orders getting into the market? What are these institutional traders using to get into these positions, and where? Well, unlike commonly used support and resistance levels, bankers levels are based on what is referred to as round numbers. These levels have numbers that end in the following numbers: 0, 0, 2, 5, 5, 0, and 7, 5. And you can see in the following examples, we have these levels: 1.2300 for euro, Aussie dollar 0.8325, ending in 25, pound yen 144.50 for the 50 level, and dollar CAD 1.3575 for the 3/4 line. Now these are what you would use in short-term trading. These are short-term levels that you'll see on a chart. You'll be able to recognize these support and resistance levels and find that price actually reverses and turns and changes direction at these particular areas. However, additionally, there are larger support and resistance zones divided up into 250 pip increments with 4/4 lines, or 250 pips, equal to one handle, which is also called 1,000 pips. Okay. Now notice in the example above at a weekly euro chart how significant turning points in the market happen at or near these 250 pip bankers levels. Now these levels are easily identified and marked on a larger time frame. Then traders can move down to lower time frames to pinpoint entries at or near these significant areas. No matter what method is used, the goal is to determine the turning point or point of continuation of the market. When a bullish uptrend approaches a significant level of resistance, traders who are long can manage their trade in a couple of ways. They can take partial profits and move the stop up or trail to lock in profits while taking a chance that price may break the resistance level. Or they can take profit and close the position just before it reaches resistance. The same process would be done in a downtrend going from support to support. Traders can even place pending orders to enter and exit these levels automatically without being in front of the computer. Just merely identify those areas and placing either a buy stop to enter above market or sell stop to enter below market at a significant level of support or resistance. Or in case they want to buy a bounce from a level, they can place a buy limit at the support level, looking for price to bounce from that area. Now, if they're looking for a price to drop, they can use a sell limit to sell at a higher price at or near or against that bottom resistance or support level. Okay. Now, as you can see, bankers levels are a powerful tool to find the very same entry areas and profit targets as the big banks and institutions. Now you can employ them in your own trading as well. If you have any questions, email support@elitetradersu.com. Happy pipping!